Bitcoin, often heralded as digital gold, has captured the imagination of millions since its inception. Stories abound of early adopters turning modest investments into vast fortunes seemingly overnight. Yet, beneath the surface of these success tales lies a sobering reality. The overwhelming majority of Bitcoin holders, estimated at up to 95%, ultimately lose money. This paradox raises the question: why do so many people lose when the opportunity for gains appears so enticing? Today, we'll uncover the crucial missteps that cost investors dearly and how you can steer clear of them. At first glance, Bitcoin seems straightforward. Buy low, sell high, and ride the waves of a revolutionary technology. But behind the scenes, the world of Bitcoin is a complex ecosystem fueled by speculation, hype, volatility, and human psychology. Most people enter with dreams of quick riches, yet few recognize the traps that await. The first and most pervasive mistake is chasing hype. Bitcoin's history is punctuated with euphoric bull runs, each drawing in waves of new investors. Mainstream media, social platforms, and celebrity endorsements create a fear of missing out, FOMO, that's almost impossible to resist. People rush to buy after hearing about friends or influencers making staggering profits. But by the time the average person hears about a price surge, the smart money, seasoned investors and institutions have already positioned themselves. Retail investors, acting on emotion, often buy at or near the top, just before a sharp correction. When prices inevitably fall, panic sets in, leading many to sell at a loss rather than weather the downturn. In this cycle of greed and fear, patience and rationality are frequently abandoned. Another major pitfall is a lack of understanding. Bitcoin is not just a stock or a simple asset. It's a decentralized, highly volatile digital currency with a unique set of rules and risks. Many buyers jump in without grasping the fundamentals: how transactions work, what drives value, or the significance of private keys and security. Without this knowledge, investors are vulnerable to scams, phishing attacks, and loss of funds through simple mistakes, such as sending Bitcoin to the wrong address or mismanaging their wallets. Leverage is another silent killer. Seduced by the promise of magnified gains, some traders borrow money or use derivatives to bet on Bitcoin's price movements. While leverage can amplify profits, it equally magnifies losses. The crypto market's notorious swings can liquidate leveraged positions in seconds, wiping out entire accounts and leaving traders deep in debt. Often, the allure of quick wealth blinds investors to the inherent risks, leading to catastrophic outcomes. Timing the market is a game very few win. Many newcomers believe they can predict Bitcoin's next big move, buying and selling based on short-term trends or gut feelings. But Bitcoin's price is influenced by a complex web of factors: macroeconomic events, regulatory news, technological developments, and the unpredictable sentiments of millions. Even professional traders struggle with consistency. The average holder, lacking experience and tools, is more likely to buy high and sell low, repeatedly compounding losses. Security lapses represent another common downfall. Unlike traditional bank accounts, Bitcoin ownership comes with the responsibility of safeguarding your own assets. If you lose your private keys, fall victim to a hack, or store your coins on an insecure exchange, your Bitcoin can be gone forever with no recourse. High-profile hacks and scams have cost individuals and institutions billions over the years. Many losses are not due to market movements, but to basic mistakes in security and trust. Impatience also plays a significant role. Bitcoin's price can stagnate for months or years, testing the resolve of holders. In these periods, doubt creeps in. Some sell out of boredom, frustration, or to cut perceived losses, only to watch prices surge later. The inability to hold through volatility and the discipline to stick to a long-term strategy separates winners from losers. So how can you avoid these fatal mistakes and improve your odds in the Bitcoin market? First, educate yourself. Before investing a single dollar, take time to understand what Bitcoin is and how it works. Learn about blockchain technology, the principles of decentralization, and the risks associated with digital assets. Know how to store your Bitcoin securely and never share your private keys with anyone. Use reputable wallets and exchanges, and consider the benefits of cold storage for significant amounts. Second, develop a plan. Decide why you want to invest in Bitcoin. Is it for long-term growth, short-term speculation, or diversification? Define your goals, risk tolerance, and exit strategy. Don't invest money you can't afford to lose, and resist the urge to gamble with leverage. Remember, the market can remain irrational longer than you can remain solvent. Third, avoid emotional decisions. FOMO and panic are the enemy of rational investing. When Bitcoin hits all-time highs, it's tempting to rush in. When prices crash, the urge to sell and cut your losses can be overwhelming. Instead, stick to your plan. Many successful investors use a dollar-cost averaging approach, buying small amounts regularly regardless of price. This reduces the impact of volatility and removes emotion from the process. Fourth, focus on security. Treat your Bitcoin like digital cash. Use hardware wallets for large balances, enable two-factor authentication on exchanges, and beware of phishing scams. Double-check addresses before sending funds, and never disclose sensitive information online. Remember, in the world of Bitcoin, you are your own bank. Act accordingly. Fifth, think long-term. Bitcoin is still a young and evolving asset. Its price history is marked by dramatic booms and painful busts, but the general trend over the past decade has been upward. Those who held through multiple cycles have often been rewarded, while those who tried to time the market or react to every swing have struggled. If you believe in Bitcoin's long-term potential, patience and conviction are your greatest allies. Lastly, beware of overconfidence. Even seasoned investors can make costly mistakes. Stay humble, keep learning, and diversify your portfolio. Don't put all your eggs in one basket, and remember that no investment is guaranteed. In summary, while the promise of Bitcoin is real, so too are the risks. The reason 95% of holders lose money isn't due to bad luck, but to predictable errors, chasing hype, neglecting security, gambling with leverage, and acting on emotion. By educating yourself, planning ahead, and maintaining discipline, you can avoid these common traps and give yourself the best chance to succeed in the world of Bitcoin. Remember, in investing as in life, slow and steady often wins the race.